Morning, everybody. Thanks so much for taking the time to be with me here today. So firstly, I just want to say congratulations to you all. MIT has got to be one of the best, if not the best, university in the world. And I say that as someone that I don't think could ever get accepted to this sort of university. And I think the opportunities that you all get, please come in. I think the opportunities that you get here to meet and speak with various different people, such as myself, and obviously probably far more esteemed people as well, are opportunities I'd encourage you all to seize, as that's something when I look back on my university days, I wish I'd done more of. So the title of my presentation today is slightly different from what many other speakers might come here and present. It's how not to identify a winning business. So before we kick off, my compliance department has told me that I have to have this disclaimer at the start of the PowerPoint. You probably have seen this before. Essentially, this is to tell you that everything within the presentation is just my opinions. Nothing is meant as a financial inducement to buy or sell any securities that we might discuss during today. And then obviously, if you want to read the full thing, you can do that in your own time. So the title of my speech will become a little bit more apparent once I explain to you how I came about with the title. So I presume all of you know, sorry, difficult to see where we are on the screen. I presume, just show of hands, everybody knows who the gentleman on the left is with the blue tie. So it's Warren Buffett, the chairman of Berkshire Hathaway, previously the CEO until last weekend as well. And then show of hands, the gentleman next to him with the red tie. Everybody knows who that is. So that's Charlie Munger. So he's was the vice chairman of Berkshire Hathaway. And Charlie pioneered this idea of using mental models to evaluate the world and to solve problems. And the one that we're going to be using today is the mental model of inversion. So essentially, inversion is a Stoic philosophy that was practiced by the Roman Emperor Marcus Aurelius, and he lived from 120 to 180 AD. He was a general, so in his Meditations, which is his famous book, most of his references are to battlefields. So here he says, instead of thinking about how to win on the battlefield, one should consider the opposite, how to avoid losing. And Charlie has taken that to a modern equivalent where he said, invert, always invert. Turn a situation or problem upside down. Look at it backwards. What happens if all of our plans go wrong? And that is why today we're going to be exploring how not to choose a winning business. So I'll kick off first with a little bit about myself. So my name is Ardal Loh-Gronager, and I'm the managing partner of the investment partnership Loh-Gronager Partners, which I'll explain to you a little bit more about in a minute. So I'm responsible for all of the investment decisions, and I run our global fund. I'm also the author of a book called The Perceptive Investor, of which I have a copy here that's signed. So whoever asks the best question during the Q&A gets a copy. So hopefully that encourages some good questions at the end. As background on myself, I'm half Danish, but born in the UK, and educated abroad in Europe, Asia, and Australia. I studied accounting and finance at university, and I have a 10-year, roughly, track record in the financial services industry. I started with internships in sales and trading at Goldman Sachs and Swiss Re Asset Management. I then moved to be an interest rates trader at Morgan Stanley, where I learned the macroeconomic side of the investment business. I then moved to be a credit trader at Credit Suisse, where I learned the microeconomic side of the investment business. And from there, I moved to be the chief investment officer for a UK-based family office before launching our investment partnership. So, who are Loh-Gronager Partners? We're an investment partnership based on the principles of the original Buffett partnerships, which Warren Buffett ran in the 1950s and 60s. So these are essentially the hedge funds that Warren ran before he took over Berkshire Hathaway. Now, we run a global portfolio of concentrated long-term investments, but each of our portfolio businesses have a few things in common. They have strong growth potential, widening economic moats, and then for us, the most important characteristic is they're run by high-integrity management that think like we do as real business owners. I thought it made sense to give you a little bit of an overview of the hedge fund industry as we see it. The term hedge fund actually came from Alfred Winslow Jones. He's widely credited of starting the first ever hedge fund. And it comes from the idea that he had a basket of stocks that he went long, and against that he held a basket of stocks that he went short, hence the term hedged fund. Now there's a plethora of different investment strategies, but the model you can see here at the bottom of the slide. Essentially you have a group of investors, such as the investors that I have, that entrust me, the hedge fund manager, with those assets. And I, as the manager, then invest them in a portfolio of securities to achieve, hopefully one would hope, over time, achieve a specified rate of return for my investors. So I mentioned that there are a lot of different strategies. There are about 10,000 hedge funds in the industry, and the annual turnover is about 20%. So that tells you that a lot of people in the industry have already received a copy of this presentation because clearly they know how not to run and invest in successful businesses. They manage a total of about $4 trillion of assets, and as you can see, the range of strategies is everything from merger arbitrage to macro to equity long only, which is what we do, and quantitative strategies. So to come on to the topic of today's presentation then, how not to identify a winning business. So I've identified 4 rules that I'd like to share with you today. So the first rule is don't be a value investor. So what is value investing? Well, traditional value investing, or as I call it, value investing 1.0, was practiced by Ben Graham, and essentially what he advocated was purchasing a large portfolio of stocks that were trading below their intrinsic value, and that's known as cigar butt investing. We then moved to what I would call traditional growth investing, which is pioneered by Phil Fisher, and that's where he says to purchase a concentrated portfolio of securities with compelling growth prospects. And essentially what Buffett did was combine the two into what we call modern value investing. And that's where he's looking to purchase great companies at fair prices, and where feasible to purchase the entire business. He wants to run a concentrated portfolio operating in a diverse range of sectors and then hold them indefinitely. And I think here what is well summarized is the quote you can see at the top from Charlie Munger, where he says that all investing is value investing, where we're trying to buy an asset for less than its intrinsic value, as everything else is speculating. So if we want to make sure that we're not going to buy winning businesses, we want to make sure that we're speculating, not investing. Rule number 2, don't have a tried and tested investment process. I boiled this down to 3 rules within an investment process. So the first would be, don't invest within your circle of competence. So when you don't understand a business, you should look more at it, and if you do understand it, you should chuck it in the too hard pile. Number 2, don't invest with a margin of safety. So we should ignore what Buffett says, which is rule number 1, don't lose money, and rule number 2, don't forget rule number 1. And the third rule is don't allow Mr. Market the time to take care of the rest. And by this I mean, as an investor, don't have the right temperament to allow or incorporate enough patience into your investment process to allow the thesis behind your investment to be carried out. And this I actually think is the most important one. And you can see why in the chart above me here on the, well, from your side, it's from the right-hand side. What this shows is Coca-Cola stock. So it IPO'd in 1919, $40 a share. And what you can see there is the price chart from the IPO through to today. So between then and now, you've had the Great Depression, you had World War II, you had pandemics. Recently you had a pandemic, but you also had epidemics, inflation, deflation. And despite that, if you'd bought one single share at the IPO price of $40 in 1919, held it through to today while reinvesting any dividends received, that position would be worth over $10 million today. And what that shows me as a concentrated value investor is that the sheer earnings power, if you invest in an exceptional business, will far outweigh any and all extraneous or macro factors that we might get drawn into by the media on a day-to-day basis. Rule number 3, don't have a framework for portfolio construction. Now it makes sense as an investor when someone says that we're looking to buy businesses that immediately we jump into that process and we look at what businesses can we buy. But actually that's going one step too far. First, we should be deciding what is our portfolio going to look like? What's our portfolio construction process and methodology? That has to come before the individual security selection process or the businesses that we're going to put into it. So on that basis, if we don't want to succeed, we're going to totally ignore this slide and everything I'm going to tell you, and we'll dive straight into the next one, which is the security selection process. If we were going to run a successful investment strategy, what would we do? Well, all of the academic research shows, and most of the practical research also shows, that over a long enough time frame, there are only a few things that really matter. So the first is that you've got to run a concentrated portfolio. The second is that you need to be long-term orientated. The third is that you have to be value-focused, which comes a little bit back to the first rule we looked at. And the fourth is that you have to evolve your investment process over time, because that's something that you can control as situations and the environment around you changes, versus fixating on the investment outcome, i.e. the results of your buying and selling, which is something that you can't control. And this comes a little bit back to the previous slide where we looked at value investing and what it was made up of. Buffett combined two different schools what we might call value investing and growth investing into an entirely new school. So that's an example of evolving your investment process over time. In our quest then not to select a winning business, as I said, we're going to totally ignore this slide and we're going to dive straight into the security selection process. What that will essentially mean is that once we find businesses, we're going to have a very vast range of different businesses with no distinct strategy of how they fit together. Rule number 4, don't have a rigorous individual securities selection process. I thought the best way to describe this might be to explain what I believe a rigorous security selection process actually looks like. And then obviously, for the purposes of this presentation, we'll make sure that we do the exact opposite. So I think the best way to describe it is a funnel approach. At the top of the funnel, you have the entire universe of investable securities. So there are about 45,000 listed equities globally. So from those, you need to source your investment ideas. Now, how might you go about doing that? Well, Buffett, if any of you watched the AGM from last weekend, will have seen that he talked about turning the page. And what he was referring to, though, there was the old Moody's manuals that he used to source investment ideas from. And that is the first category here, which means starting with the A's. And essentially what Buffett did, because that's how the Moody's manuals were printed, was they were printed alphabetically, A through Z, of all the listed businesses in the US. And what Buffett says, the best way to find investments is you start with A and you end with Z, and you flick every page in between. Now today that might seem a bit perverse where we have all sorts of different other tools, such as screening. But actually Buffett hits on something really important, which is that to find exceptional investment ideas is incredibly difficult. And actually most manual methods of screening won't show them up. So to find the diamond in the rough, you might have to do, as he said during the AGM, the really hard work, which is turning the page. Another way might be cloning. So that's where we look at the portfolio holdings of other exceptional investors and look at their potentially largest holdings and try and reverse engineer why they might own those businesses. The other might be the media, so reading newspapers, trading in industry journals, reading investor forums, or attending industry conferences, all with the idea of trying to find interesting investment ideas. From there, we move to the second step. So this is where we're going to evaluate the potential investment opportunity. So this is the central core part of the funnel. And for me, there are 3 steps to this. The first and most important is the circle of competence test. Does this business fit within my circle of competence? Can I truly say that I understand how this business works and makes money? If not, it needs to go in the too hard pile. And that's okay, because there are 45,000 listed equities globally. So if you're not putting almost all of them in the too hard pile, you clearly don't understand your own circle of competence. The second and third steps are designed to test the margin of safety around the business. And hereby we're trying to work out what's the discount to intrinsic value that the business is trading at. So the first of these is the quantitative analysis. So here we're evaluating the balance sheet, income statement and cash flow statement of the business. We want to really understand the numbers behind it. Now, personally, I don't attribute a very high weighting to this part of an analysis of the business. And the main reason being that we're all using the same financial data. And we're all trying to project forward something that I believe is actually impossible, which is essentially the future with any degree of certainty. Therefore, we don't attribute a very high weighting here. What we're trying to work out is from footprints in the snow of this business, as I call it, i.e. the past financial record of the business, how do we think it's going to perform in the future? The second step, which we do attribute the highest weighting to, is the qualitative analysis of the business. And the reason for that is that it's where your opinion and my opinion actually might differ substantially. And therefore that's where we add value as the investment manager in selecting the securities that go into the portfolio. So here we're evaluating all the publicly available information on the business. Annual reports, quarterly reports, management calls, AGM Q&A, newspaper articles, manager biographies, industry analysis, competitor analysis, absolutely anything and everything related to the business and its competitors and the environment within it operates. Because we're trying to see if we can form a differentiated view from that which is held by the market. The final stage is the investment decision. So here we're deciding, do we want to buy the security or buy the business if we think that it passes all of our investment criteria? Do we want to sell it if it's a current holding and actually it's exceeded all of our expectations, or perhaps our investment thesis has been disproved? Well, the third is it a hold, whereby we believe our thesis is intact, but it requires more time for it to be carried out? So I think what you can see from this process, from the overview that I've given, is that our objective is to rationally and objectively evaluate each potential investment opportunity. We're trying to ascertain whether it sits within our circle of competence, whether it meets our investment criteria, and also how it would fit within the context of our existing portfolio if it is a new holding entering into it. The search for exceptional investment ideas requires, on the one hand, extreme patience, and on the other hand, complete intellectual honesty while you go through this process. So given that we're in the business of not selecting winning businesses, we're going to make sure that we don't incorporate either of those two things into our investment process. So to summarize then, how not to identify a winning business, I'd say don't be a value investor. Don't focus on buying assets for less than their intrinsic value, i.e. be a speculator. 2, don't have a tried and tested investment process. Don't invest within your circle of competence. Don't invest with a margin of safety. Don't have the right temperament or patience to allow the thesis behind your investments to be carried out. Thirdly, don't have a framework for portfolio construction. Always fix on the investment outcome versus evolving your investment process over time. Fourthly, don't have a rigorous individual security selection process. So don't have a system for generating ideas. Don't have a checklist process for analyzing them. And don't have a structure for making your investment decisions. And then I would conclude by saying, most importantly, don't remember the famous words from Buffett, that your goal as an investor should be simply to purchase at a rational price a part interest in an easily understood business whose earnings are virtually certain to be materially higher 5, 10, or 20 years from now. Over time, you will find only a few companies that meet those standards. So when you see one that qualifies, you should buy a meaningful amount. And with that, I'll just say thank you very much for your time, and I'm very happy to answer any questions that you might have. And remember, there's a book going for the best question. Sorry, sure, in the front.
So I'll go for 2 then. First one would be, I'm a bit interested about learning about your portfolio. So what would be like your top 3 holdings? And are you close to actually selling them, or how do you see them at the current stage in the economy? Like, how much longer do you see yourself holding them?
So it's really good that I have the disclaimer at the beginning of this presentation, because then when this is seen outside, it's clearly shown that this is not investment advice that I'm giving today. So we don't talk about our current portfolio holdings. And one of the reasons is for exactly the reason we discussed here, a mental model, the mental model of inversion. There's a lot of biases that can creep into your investment process when you talk about them. So I can talk about them in broad steps, and I can talk to you about past investments. What I can tell you is that we believe in running a long-term concentrated portfolio. So since we launched our fund 3 years ago, our top 3 holdings have started at roughly 9% of our fund, and they've now grown to just under 25% of our fund 3 years later. So what that shows you is that we really do believe in letting our winners run. We think in a concentrated portfolio of roughly 20 stocks, which is roughly what we hold, 10 developed markets, 10 emerging markets, split across all sorts of geographies, across all sorts of sectors, which gives us diversification of the portfolio. But we really believe that within that, you have to allow your winners to run and compound over time. It's really buying, like I believe, that if we fast forward our fund's track record to say 10 years in and 15 years in, the top 3 positions of the portfolio wouldn't surprise me at all if they make up 70 to 75% of the fund. Because that's where you generate alpha as a long-term investor. It's when you cut your winners over time, which is human nature. What we actually tend to do is we ride our losers too long and we cut our winners too quickly. And that's exactly the antithesis of what we should be doing. And that's the mental model that we've evolved over time, which is commitment and consistency bias, which is why we don't talk about what we hold currently as individual stocks, when we talk about them more broadly. I can give you an example of a business that we did purchase and that we've sold. So when we sell a business, because we're concentrated long-term value investors, as I've said, then actually what I believe is we've made a mistake. So I really enjoy talking about past investments, because it doesn't matter whether we made money or lost money. It was clearly a mistake. Because if we're concentrated long-term value investors, we should essentially be buying these businesses and holding them forever. So if we've sold it, clearly we've made an error. So an example of a business I can give you is Credit Acceptance Corporation. So Credit Acceptance Corporation is quite a widely known business within the value investing space. They don't trade, they trade relatively cheaply, They are a type of business that we really like. It's called a cannibal business, or that's what we call it, which means that they consistently buy back their shares quite aggressively in the market. And essentially what that means is if you like the business, you end up owning more and more of the pie over time. The reason why it was a mistake for us was the fact that Credit Acceptance's business model is essentially to lend money to people that can't necessarily afford through normal methods of borrowing for car financing. And one of the clever things they've done is essentially when they take the borrower, they lend the money to the borrower doesn't come to them directly, it comes to them through the dealership. And the dealer actually takes a percentage of the loan onto their own balance sheet. So that way, Credit Acceptance makes sure that we don't have the same issue that we had during the subprime mortgage crisis, where the mortgage lenders are essentially just giving mortgages to people that can't afford them and can never pay them back. Because here, the dealership, they want to sell you the car, but they need to make sure you can afford to pay it, because they're on the hook for roughly the first 10 to 20%. So consistently over time, it's a good compounding business model. It has a very sticky client base, as you can imagine. It has a dominant market share in that part of the market. The issue with the business is that it's not a win-win-win business. And that's the reason why it was a mistake for us. And by a win-win-win business, that's something that we now look for in all our holdings. And that means that the client, the ultimate client of the business, does well. That's clearly not the case with Credit Acceptance, because essentially you could argue it's slightly predatory lending. You're charging very high interest rates to people that can't necessarily always afford to pay them. It's a win for the business because it's highly profitable, and therefore it can be a win for me as the shareholder, as the share price might go up over time. But that cycle of a win-win-win business, and I can give you an example of a win-win-win business, and that would be Costco. Costco is an incredible business in that respect, whereby they have a fixed margin on the price above which they sell all their products, which is 15%. And Costco, as it gets larger and larger, has economies of scale when it comes to purchasing goods. So as you can imagine, actually, as the price of purchasing their goods goes down over time and they keep the margin consistent, actually every time you go to Costco, everything seems to be a bit cheaper than last time you went. And that drives loyalty with you as a client and makes you want to keep going back. But arguably, Costco could make far more money with their economies of scale by keeping the price where it currently is and squeezing all their suppliers and increasing the margin. So that's an example of a win-win-win business, because you win every time you go. The business wins because it's growing over time with more customer loyalty, more repeat customers. They open more stores, increasing economies of scale, decreasing the purchase price, therefore increasing the gains to you. And that flywheel approach makes me as an investor very happy. And I think if you look at Costco, it's one of the best long-term compounders in the market. So thanks so much for your questions.
Thank you.
I'll just take the lady in the back.
Thank you so much for being here today. I do have quite a few questions, but I'll start with one. You were talking about that it seems as though you only tend to really sell if you feel like you've made an error, sort of in a broader sense. So what is your error correction process?
So,
error identification process.
Sure. So I think that we talk an awful lot. So I really like that question, because I think we talk so much about how to buy a stock. What do you own? Why do you own it? How do you buy it? I don't think we talk anywhere near enough about how do you sell a position? Why do you sell a position? Because actually you're only really making the money once you've realized that gain or loss. You've made or lost the money. So for us, we've got 3 rules, because I think that it's an art for selling. There's actually no science to it. So we boil it down to 3 rules. So the first is we sell if we're clearly wrong on our original investment thesis. So at my fund, we have a 250 question internal checklist, and that's the process that we run through, both quantitative and qualitative, to evaluate all businesses. Now, the purpose of that checklist is not necessarily that the business gets 250 points. It's actually that it helps us to dive into the areas that we think might be potential red flags that warrant further investigation. No business is ever going to get a perfect score, because there is really no such thing as a perfect business. And that checklist has been built up over time from all the mistakes that we've made. So, for example, a new question on our investment checklist is this a win-win-win business? Now, another way of checking that would be, one of the questions on our checklist is, would I be proud if my son or daughter was the CEO of this business? Another way of checking, is it a win-win-win business? So that's the first step. So you've got your investment process, you've got your investment checklist in our case, and we run through that before we buy an investment. Now, if new information comes to light that clearly disproves our original investment thesis, i.e. we're wrong, we sell the investment straight away. Now, the second thing that might happen would be that we've estimated as part of our investment process the discount to intrinsic value that the business is trading at. So for simple purposes, let's say the business is currently trading at $100 and we think it could be worth $1,000 in 10 years' time, 10 to 1 return. Now, let's say that business achieves a $1,000 share price within 6 months. Now, we'd look back at our original investments thesis and we'd be like, okay, so we've actually realized all of the gains we were hoping to achieve. It's only been 6 months. We thought this would take 10 years. Do we sell? So we'd look at the fundamentals underlying the business and see, had they changed at all? And actually had the business followed our trajectory of growth, or had the market become incredibly overpriced? In which case we'd sell. So essentially rule number 2 is you sell when the discount to intrinsic value is not substantial enough relative to the risk you're taking. And then the third reason why we'd sell, which I actually think is the most common in our case, but also I'd argue the one most susceptible to mistakes, is we sell when we find a better business that we want to include in our portfolio, and we think that current holding doesn't offer the same risk reward as the new business we found. Now, I think the reason why this is so difficult is because the grass is always greener. When you own something and you sit, like if you own a car and you see a different car on the street, you think that car looks so much better. But if you ask the driver what it's like to drive that car, he might tell you should be happy with the one you're currently in. And that's that issue that the grass is always greener. The thing is, once you own a business, I feel like that's when you really get to know the business, because you have skin in the game, you have real money at risk. So that's when you're going to be listening to the management and quarterly calls, when you're going to be doing the deep dives on the accounts. And therefore, the new business that is going to enter your portfolio, if you are going to sell a current holding to replace it with a new one, the burden of proof on it has to be really high that it's better almost in every way, I would say.
Thank you. Are you done with your questions? Sorry.
I'll do it a little.
So 2 questions. Going back to your slides around your investment decision, one, there was a part where you mentioned that you need to see how your investment fits into the context of your portfolio. Most of the stuff that we talked about are like individually assessing companies, but I want to know more about how it fits into the overall portfolio. And the second question linked to the first one is that you talk about a concentrated portfolio, and how does that mean like correlation in returns? And if that's the case, how does that fit into the whole diversification of your risks as a strategy?
Really interesting question. So on the bottom of this slide, I didn't mention it during the presentation, so modeling. So modeling is important as part of an investment process because you're managing a portfolio. So to your point, it is important when you are managing a portfolio, from my perspective, that when you're looking at a new investment, you do want to see how it will affect the overall risk of your portfolio when it's included. Now, for us as value investors, you could define risk as a permanent loss of capital. So we don't agree that risk is the same thing as volatility as an investor. That being said, you need to understand that a lot of people in the market do see volatility as risk. So therefore, how volatile your portfolio is as an investment manager is actually an important thing to know. What's important is the journey for your investors. So if you think about it, I've already said earlier in the presentation that as human beings, it's essentially ingrained in us that we'll buy high and sell low. So on that basis, what we want to essentially ensure is that we have the smoothest possible path for our investors. We don't want to expose them to plus 50%, minus 50% days unnecessarily. Because what that will induce is the tendency there to buy high and to sell low, no matter how well-meaning your investors are. Because we all have a different temperament when it comes to investing. And so it's a really important thing to know. So although Buffett says, as I said before, that for us, risk is the permanent loss of capital, we do think about risk in terms of volatility as well. That doesn't affect what securities go into the portfolio. It's just that we're very cognizant of it. So I do have a slide that I put in later. Forgive me because I have to skip through because I can't remember. That's helpful. So it's right at the beginning. So concentrated investing. So what is concentrated investing? So one of my favorite quotes on this is from Charlie Munger, that a lot of great fortunes in the world have been made by owning a single business, not a diversified portfolio. I mean, if you look at the richest family in the world, the Walton family, what do they own? They own Walmart stock. It was given to them by their father, who founded Walmart. They've owned it for 60 years. They've owned it since the IPO. In the IPO, they owned 35% of the stock. Today, they own 50% of the stock. And that's because of buybacks and the fact they haven't sold any. And they're the world's richest family because they own a business that's absolutely exceptional. And they're concentrated in that one business. So how does that go with the portfolio? So if you look at the graph here, what essentially it shows you here is the distribution of returns on a stock portfolio. So what you can see is the more stocks there are in the portfolio, so if we look at the yellow line, that's 250 stocks in the portfolio, the narrower the distribution of returns. So obviously, conversely, the green line, which is a 10-stock portfolio, has the widest distribution of returns. Now, we're looking to outperform the market. So to do that, we need a portfolio that has a differentiated set of holdings from the market. So the first way to do that is to have far less holdings than the market. And then the second step from that is obviously to make sure the individual businesses you've identified are significantly better than those in the market itself. So on the second point, there's no point in just saying I'm a concentrated investor and just buying 20 stocks when the S&P 500 has 500. That's not going to make you necessarily outperform. What the chart here shows you on the bottom here shows you the distribution of lifetime returns for all the stocks in the Russell 2000 index from 1980 to 2014, so 34 years. And what you can see from that, interestingly, is that the median return is below zero. So what does that mean? Well, it essentially means that the average stock in the average return during this 34-year period of time for a stock in the Russell 3000 index was negative. And what you can see is the distribution is a very fat tail. 4% of the businesses basically produced all of the returns. So you need a strategy that helps you pick the long-term winners. And that's why you should be a concentrated investor. But it also comes back to why you need to be a value investor. Because it's those businesses, those exceptional businesses that we're trying to identify. Which comes back to the gentleman's first question and my answer to that when I said, we're letting our winners run. Because when you identify a winning business, they're really, really special. And you now need to allow the winners to compound over time. Thank you. And then I'll come over here. Sorry, I feel like I'm looking this way.
I have two very, very different questions.
Sure.
So first one is about the circle of competence, which you mentioned was one of the more important things. And then that in the context of like the broader hedge fund landscape right now. So now with like all the massive hyper-levered multi-strat hedge funds that run very sector-specific teams, I'm curious how you kind of like compete with those, especially when a lot of like their sources of alpha are kind of like very specific data feeds. So you might not even be playing the same game with them, but I'm curious how you manage like those conversations with like potential investors in your fund, for example.
Sure. Remind me just the first question.
That was it. Like the like how you manage
Multi-strat fund, but you asked me something before that.
No, that was one, and then the second one was going to be a separate one, but
Okay,
might
I'll do
be
it.
related.
Okay, so in terms of for us, when it comes to how we compare us to a multi-strat firm, so there are a lot of ways up the mountain for producing excess returns to the market. It really depends what your investors are looking for. So if you look at the multi-strat firms, they're in general not trying to beat, for example, in my case, the MSCI All Country World Index. Essentially for them, they're also not trying to beat the S&P 500, although that's what we seem to constantly benchmark them against. If you look at the biggest funds, so like Citadel, Millennium, Elliott, these guys are trying to achieve positive returns no matter what the market environment is. So that's why they essentially operate as a pod shop with hundreds of different investment strategies, all linking into one strategy. And their idea is to compound over time. It's potentially at a lower rate, despite the fact they've got enormous amounts of leverage. But the idea is that there's a consistency to it. With value investing, what you're going to find is it's the opposite. We're going to have significant volatility in a portfolio when we embrace that volatility. So if you look at the greatest investors of all time, and I argue so Buffett is arguably the greatest, well, actually inarguably the greatest investor of all time. So just in the time that he's run Berkshire Hathaway, that company has fallen more than 50% 3 times in a row. And yet ultimately he's ended up being the world's wealthiest investor. And you compare that to someone that runs a multi-strat fund, they're not going to have anywhere near the wealth level that Buffett has or have achieved anywhere near the compounding rate that he has, despite the fact he uses barely any leverage, because they're totally distinct strategies. One of them is basically solving for volatility, which is coming back to the lady's question from before, where I said volatility is something we think about when it comes to our portfolio construction, but it's not actually included within it. We don't decide on securities whether or not it increases or decreases volatility. In the very large funds, that's all they think about. They're thinking about volatility suppression and trying to capture a little bit of upside on every trade. So they're just very, very different strategies. But I would say that long term, the value approach is the most solid approach if you have a long-term and consistent approach to it. It's also, I'd say to everybody here in this room, something that you are all capable of doing. It's something that you can all do in your personal accounts regardless of what career you go on to have. To run your own multi-strat fund, though, might be a little bit harder.
And then second one, if I may. So I'm curious about your transition from being rates trader, credit trader into fundamental investing, how that came to be and how at some point you had like the confidence to be like, okay, like I'm doing this, starting my own fundamental hedge fund.
Sure. So for me, I was actually always more interested in business than I was in investing. So I started my first business when I was 7 in the school playground. We were trading Nintendo 64 games. So I was that kid in the school playground. I actually didn't buy my first individual stock till I was 17. So you could argue I was quite late. I think it's Buffett that said he bought his first one at 11, and the first 10 years were wasted, is how he put it. So for me, I came to investing because I had accumulated a fair amount of savings, and I wanted to think how to get my money to work for me in the best way. And that's essentially what led me to the approach that I have in today's market. But at the same time, I was very cognizant that there's a lot to learn. So I thought, where better to go than the actual people that do the capital allocation, i.e. the banks that work with all these businesses. So that's why I did the internships at the banks. And actually, when you do the internships, you kind of realize that, A, you need to get a job when you graduate. And the second one is there's really two sides to the business, macro and micro. So I originally thought the macro seemed a bit more interesting to me. So that's why I ended up doing what essentially macro trading, so trading interest rates at Morgan Stanley. So there, I actually sat on the desk where we were trading Greek government bonds during the European sovereign debt crisis. So as you can imagine, massive volatility. And what I learned there was really how to analyze global capital trends, broad macroeconomic flows, and their impact on interest rates. So I learned one half of what I call is the equation, which is the macro side. And then from there, I got approached by Credit Suisse to work there. And that was a micro role. So there I was trading the debt of banks. Interestingly, I was trading, which you might know about, the AT1s, which are and contingent convertibles for Credit Suisse. And those have obviously been in the newspaper a lot after UBS took over Credit Suisse. So the debt of financials. So there we were looking at the income statement, balance sheet and cash flow statements of banks and working out where within the capital structure of the bank we should be deploying our own capital and recommending our own clients to be investing theirs. So it's really the microeconomic side of the business. And the reason why they approached me was because they essentially said, you were trading Greek government bonds, they trade on a spread to Germany. It's essentially a credit spread. So that should be an applicable skill set to what we're doing here, trading the debt of banks. And then from my perspective, I was like, well, I've had good exposure to the macro side. Now I want to learn the micro, basically more in-depth stock analysis and put them together. And when you work at a bank, the one thing you can't do with your own money is invest in whatever product it is that you're trading. So therefore, all of my investments were long-term stocks that I owned in a concentrated portfolio in my PA account. And then I left Credit Suisse once I started making more money in my PA account than I was getting paid by the bank to work there. And that was essentially the genesis to start my fund. I'd always wanted to run my own fund. I didn't know what it was going to be. So when I was in university, I set myself a goal. I said, I'll work 10 years in finance. I'll start my own fund with $10 million. I didn't know what it was going to be doing. I didn't know whether it was going to be macro or micro. I thought I would learn that over time. It actually took me 11 years, and I only started with $8 million. But who's counting?
I think my question is around the timeline. So if we look at graphs, all of these graphs that show like 100-year timeline, eventually the stock has grown exponentially. But during those moments, the stock is also, a really good business is also going through bear cases, like it's going to dip. How do you bifurcate in those moments whether this is an external risk or whether it's because of what's happening to the business? And I know that there could be any external factors, but sometimes those lines can be blurry. For example, recently Buffett was selling a lot of the Apple stock, right? Hasn't been holding it for that long either. So I'm curious, like, what are the metrics that you use to bifurcate systematic risks from others?
It's a really nice question, that one, because it essentially comes to the heart of your investment process. So thank you for that. So, if we look at this chart, which I referred to during the presentation, Coca-Cola stock, right? You can clearly see there are some lines on that chart which are quite jagged. So the nearest one to us, the second nearest one to us, the largest one there, that's going to be the 2007 to 2009 global financial crisis, where I think Coca-Cola stock fell something like 60%, i.e. roughly the same as what the market fell. But what you can't see on the chart, because it's somewhere down here, is the 1929 Great Depression. So, to your point, you're absolutely correct. Over time, if you have a long enough time frame and you find an exceptional business, these short-term, although they might feel it in the moment, incredibly volatile situations, they pass. And actually, you get to a stage where you can't even see the Great Depression, which was the greatest capital extinction event that we've ever had in relative terms. You can't even see it on Coca-Cola's chart anymore. But to your point as to how do we differentiate between where our investment thesis is no longer correct versus short-term volatility? It's a really nuanced question. And I think you have to look at it on a business-by-business basis. Because what you're trying to ascertain is, what's the discount to intrinsic value that I bought the business at, and what's it currently trading at? And the only way to know that is to look at the fundamentals of the business when you bought it versus the fundamentals today. So if the share price is, let's say you buy a stock today for 100, and it's passed all of your investment criteria, and your thesis is, over the long term, the next 10 years, it's going to be a 10-bagger, so it's going to go from $100 to $1,000. Now, let's say tomorrow it drops to $50. What do? Well, the first question I ask myself is, what has fundamentally changed about the business? Now, if you tell me that it's because China has invaded Taiwan and the whole market has fallen 50%, I think it's totally irrelevant to my business, to the degree that probably everything in the market has fallen substantially. The only question I'll then ask myself is, how exposed is this business to a geopolitical situation like that? And long term, do I think that that is going to change the world in its entirety, or do I think, as like most things in markets, this too shall pass? The fundamentals underlying the business is the most important thing. And it's one of the reasons why you have to have a long-term investment time horizon. So if you look at any stock, and most of you've got a computer or a phone in front of you, but do this after I finish talking. If you look up any stock and look up the 52-week range, any stock you can think of, in general, the amplitude is going to be more than 50%. And by that I mean, if the stock's 100, the 52-week range will be 125 to 75. And it doesn't matter what stock you look at. Now, fundamentally, do you believe that, for example, Apple or Meta or Alphabet is fundamentally 50% better or worse during any 52-week time horizon? Absolutely not. Businesses just don't work like that. And as someone that's run a few businesses and worked in a few businesses, I can tell you that as a fact. Business is messy. So for us, what we want to see is the 5-year rolling average of all the metrics across the income statement, balance sheet, cash flow statement. That's what gives us the confidence to project forward the future of the business, not any short-term or near-term volatility. And that's why we don't attribute a very high weighting to quarterly reports, because no business really changes fundamentally quarter to quarter. It's like me asking, how do your grades do during the course of a year? You might have done badly in one paper in the first quarter. Doesn't mean you're not going to do really well in 2, 3, and 4. What I care about is what's your grade at the end of the year. And then actually, what do I care about? I care what do you graduate with, 3, 4, or 5 years down the line. That's what really counts. And it's the same thing in investment. It's the same methodology in value investing. Thank you. Right.
When you're looking at a new idea and a stock, screens cheap for a variety of different metrics, how do you differentiate what seems like a good opportunity versus potential value trap?
So one of the things we really like to do on my side is we like to do sort of peer review. So when you identify a business, I think one of the key things to do is to look at how is it performing relative to all other businesses within that sector. We actually go a lot deeper than that. So in general, we'll go and we'll meet the management team. In general, we'll meet the management teams of competitor businesses. We might not even tell which business we're thinking of buying shares in, because we don't want to have any sort of biases. A good question to always ask, and you can actually, you can find this on Glassdoor and various different message forums. You can usually get feedback from previous employees, or you can reach out to them on LinkedIn if you want to do a bit more in-depth research. But the real question to ask, in my opinion, is, if you could work for any company in this industry, which company would you work for? And I think the employees at all levels can give you a really good insight into who the industry leader is, without even looking at the financials of the businesses. Because if the majority of the people you speak to about a business point to one business, then it's probably worth doing a bit of research into that one to find out why. It could be that that business is actually the best performing in the industry, and actually all of the financial metrics reflect that, the valuation reflects that, in which case maybe it's not a good buy because it's not trading at a good enough discount to intrinsic value. But sometimes what you can find is you'd add that to your watch list and you'd be like, okay, so if this business enters a significant period of turmoil, I might look at it again and see if I can buy shares in it. The other one might be where you do identify value, because actually everyone's telling you it's a great business, and actually the fundamentals of the business aren't quite reflecting that. That would be where it warrants further investigation. And that's where it comes down to qualitative versus quantitative analysis. Like quantitative analysis, all of us can do. We've all got the tools to do it. It's the qualitative analysis that differentiates your view and my view potentially from the market.
I have 3 questions.
You get 1 to start with.
I'm actually curious. So I spend most of my life as a short seller. So very different from what you guys do. I'm curious why the decision not to short, especially when you think about stocks. Most stocks actually go down, and most businesses go out of business over time. the stock market overall goes up because the winners are taking the average up over time, but most businesses fundamentally are shorts, especially over a long time period. Obviously, you have to like ride out, short squeezes and businesses doing well and beating estimates. But I'm curious, why not short, especially when there's a lot more opportunities to short than opportunities to go long businesses that have that compounding effect?
So Lorenzo, it's a really great question, but you definitely don't qualify for the book because you organised today's talk.
I was trying. I was going for it.
But so what you're referring to there, I think, is a little bit what we touched on here when we talked about the chart here, where 4% of all the returns in the stock, 4% of all the stocks in the stock market over this period of time, basically all the returns, and the median return was negative of the average stock in the stock market during that 34-year period. So yes, you could argue exactly what you said there, which is that why wouldn't you short, given that actually most businesses ultimately fail? Now, there's a few reasons. The most important one for us is the fact that it's an entirely different investment process when you're selecting a short from when you're selecting a long. To manage a portfolio of longs and shorts, I'd argue, is actually impossible to do well. Now, everybody that runs a long-short portfolio would tell me that's not possible, we do really well, we generate alpha. And I'd say it's a totally different investment process. If you manage a short book, you need to be looking at that portfolio constantly, all the time, assessing how the business is doing. Because your risk there is the asymmetry of the bet. When I buy a share in a business, my upside is unlimited. My downside is capped. I can only lose the money I put in, provided I'm not leveraged. It's the inverse when you go short. Your upside is that the business goes to zero and goes bankrupt, make 100%. Your downside is unlimited. If that business becomes a 10x tomorrow, and we saw that with what happened with GameStop. So your risk reward is not the same. There's not the correct asymmetry in my view. The second step is when it comes to managing a portfolio. I've told you that we are long-term concentrated value investors, so we take a very long-term view. That is not at all you can't run that, in my view, that strategy, along with running a short portfolio at the same time. Because as I just said, with a short portfolio, you need to have your phone with you all the time. Because if an alert comes through that basically says that one of your shorts has doubled, you need to decide what you're going to do. Am I doubling down? What's the news? Do I believe the news? The other interesting thing I find with shorts is, if you're right, they disappear from your portfolio. They become a decreasingly small portion of your portfolio. So if you short a stock at 100 and it goes to 50, and it was originally a 1% position, it's now a 50 basis point position, because the position's halved. So you're constantly churning the portfolio looking for new ideas. So there's a few of the reasons why. I think if we were to take a step back from all those practical reasons, if you look at the list of the world's most successful investors, I think you'd argue maybe only one would qualify that was a short-only investor, and I'd say that's Jim Chanos. But even Jim Chanos, who's arguably, he found the Enron scandal, Wirecard, he was Lehman Brothers. He was on top of all these frauds early on. Even he ultimately had to close his hedge fund because he couldn't consistently deliver a return in a market that generally trends upwards. So I wish you the best of luck with your strategy.
I'm here for a reason. So we kept that job.
Thank you. In front.
Thanks for coming today. And so value investing has been becoming more common and popular. Price is truly valuable, like good fundamental stocks, right? And like there's only that many stocks you can invest in, and you end up investing in the disposable Apple. And so how do you explain to the investor if they ask the question, like how do you differentiate within yourself and the bigger fund that also have the same value investment thesis? How do you explain to the investor, like, do you actually generate alpha or are you just mimicking all the funds portfolio?
It's a very valid point. If we look at the S&P 500, where for the last 2 years it's roughly done 25% a year, and where 50% of the portfolio, 50% give or take of the S&P is the Mag 7, and essentially almost all the returns during the course of those 2 years are also the Mag 7. You could argue, if your portfolio includes any of the Mag 7, what differentiation do you have as a portfolio manager from me just owning the index for free and not paying any manager fees? Very valid point. So the first thing I'd say is that as value investors, it doesn't necessarily mean because you've identified a quality business that you buy it. It's quite apparent to me that Apple and Meta and Alphabet all have exceptional business models. None of them are holdings in our fund. Now, there are various reasons for that, and the main reason is that, for me, they don't trade at a big enough discount to their intrinsic value for me today. everybody's required discount to intrinsic value is different. So for me, when we're trying to choose businesses to include in our portfolio, we're looking for businesses that we think can, at a minimum, really 10x over the next 10 years. Do I believe, so this is essentially the law of large numbers, do I believe that a company with a $3 trillion market cap today, the world's biggest business, is going to have a 30 trillion market cap in 10 years' time? It's possible, but I think highly unlikely when the GDP of the US is 100 trillion. Is, you know, the law of large numbers. There's a famous old saying that trees don't grow to the sky, right? There's always a certain point of maximum. Now, I would have also said that to you 10 years ago, and I would have been wrong for all those 10 years while these businesses have done incredibly well. They could very well continue to do incredibly well, but I think it's highly unlikely that one business in the US ends up being 30% of US GDP. So coming to your point, how do you have then a differentiated portfolio? Well, for us, we do that by being geographically and sectorally diversified. So I've told you we own roughly 20 businesses. So we have 20 full positions in our portfolio. So they start at roughly a 4% weighting, 4.5% weighting in the portfolio. And then we have 10 watch list positions, which is a 1% of AUM position. And that's coming back to what I said previously, which is I believe you only get to really know a business when you have some money in it. So that's why we have those watch list businesses. So for a full position, we have 10 in emerging markets and 10 in developed markets. So we have really broad geographical exposure. So we have investments from Thailand and Vietnam to South America to Europe and the Middle East to North America, South America. Like we cover the whole globe with 20 stocks. We also have complete sectoral diversification as well. You know, we own businesses from really high-tech IT companies to truck manufacturers, right, and everything in between. Because we're trying to identify what we think are exceptional businesses trading at a discount to their intrinsic value that we think are going to multiply our capital over many-fold over, for example, the coming decade. So I think it then comes back to what I said before, which is you need to have a portfolio construction methodology before you even start thinking about what stocks are going to go into it. What return do you want to generate as an investor? You know, if you're happy to match the index, you should be probably buying the Mag 7. They should be in your portfolio because that's going to help you to match it. If you want to differentiate yourself from the index, if you want to outperform, you need a concentrated portfolio, you need less holdings in the index. You also need to have holdings that are not necessarily in that index. So if you're comparing me to the S&P 500, I'm going to make sure that all of my holdings are not in the S&P 500, you know, broadly speaking. So our benchmark is the MSCI All Country World Index. So that encompasses roughly 3,000 businesses operating all around the globe, small to medium-sized enterprises. So we invest in businesses, everything from $100 million of market cap up to $1 trillion, you know, roughly speaking, and everything in between. So the idea there is you've got a mix of businesses, you've got a mix of sizes of businesses, you've got a mix of business models, you've got a mix of geographies. So you're still getting the benefits of diversification, but you're allowing those businesses to multiply your capital over time and concentrate the portfolio over time. Thank you.
Can I have a follow-up question?
I'll do one follow-up and then, yeah.
So how do you has the strategy been working well in emerging market, and what are the how do you navigate between how do you navigate the different nuances when you invest in emerging markets?
Yeah, so good question. So I used to be what you would traditionally call, thank you guys for coming, what traditionally be called an armchair investor. So I previously didn't really see the value of going and necessarily visiting the management teams of the businesses that we invest in. And the main reason for that is normally you meet the investor relations team whose job is to sell the business, or you get introduced to the CEO of the business and his job is really a political appointee being the CEO. Doesn't mean he was the best employee that ever worked at said business. It probably means he's the biggest cheerleader for that business. So what you're going to get is you're probably going to get a slightly biased opinion of how good the business is. I don't know anyone that's come out of a meeting with or a one-on-one with the CEO being like, I really didn't like that guy, I think the stock's terrible. Normally, they're great salespeople. And that's why I always thought you're better to not subject yourself to that potential cognitive and behavioral bias by just taking a step back and not having that involvement. What we found from our emerging market holdings, particularly in China, I learned that it's important to go on the ground. It's important to meet the competitors in person. Because what the management team might tell you about the business in their presentations, what the financials might tell you, can actually be very different from the reality that's true on the ground. I can give you, one investment example we had in China, a previous investment, which is called Angel Align Technologies. So they're a retainer or dental aligner company based in China. The reason why we invested in this business is it had unique IP. They essentially owned all the patents related to the printing, the 3D printing of dental aligners. And they're the main competitor for Invisalign, which we all know over here in the West. So they make it cheaper, faster, arguably better. Seems like a great business. Also an incredibly huge and growing market of emerging within China. We also know that Invisalign would find it very difficult to compete in China because Chinese regulations being as they are, they're always going to promote domestic competitors instead. So we thought we'd identified an exceptional long-term compounding winning business. When we got there and got on the ground though, what we realized was there were a lot more competitors than you would have thought to this business. And what it turned out was that despite the fact that this business, everything I've told you about the business is absolutely true, and it's exactly what management told us, was the fact that despite the fact they owned the patents, they couldn't enforce them within China. That was the problem. So you had copycat businesses starting up with the same IP, competing away market share and decreasing margins over time. Now we only had started to see the beginning of this in the financials for the business when I went and visited. And it was only by seeing it on the ground, the number of competitors to the business that I could actually meet, and people explaining to me on the ground these different dynamics, that I realized actually this is incredibly important. And we therefore sold that position because our original thesis was not correct. So we now have a new question on our checklist, which is if the business is based, or success is based on patents, can they be enforced in that local jurisdiction? So I think, as an individual investor such as yourself, who might not have the resources to go and visit every foreign country within which you're thinking of investing, what can you do? Well, I still think, when I answered your question earlier, there are several things you can do. So online message boards, LinkedIn, reaching out to other employees, and really exploring the competitor businesses. Because I think when you do line-for-line comparison of income statement, balance sheet, cash flow statements between the business you've identified and its competitors, you can usually work out from that what the juice is, what's the difference, why is this business better? And then that's the quantitative side. And then the qualitative side, you want to work out how do they have that edge? Is it because they've cornered a resource? Is it because they have better employees, i.e. better culture? Have they been going longer? Are they founder or owner operated? So 70% of the portfolio businesses that we own are founder or owner operated, first or second generation. And why do we like that? And why do they outperform? Well, for me, it's because they have skin in the game. So I told you when we launched our fund, we launched with $8 million. Well, that was all from me and the management team. We didn't have any external investors when we launched. And that's skin in the game. We're the second largest investor in our own fund. But in the same way, the management teams of the businesses we invest in, we want to see exactly the same. We want CEOs and management teams and boards of directors that are invested in that business. I want them to have almost 100% of their net worth invested in that business, would be my preference. Because I know then that they've got a small basket of eggs that they're going to look at really, really carefully. It's all about alignment. Thank you. Yes.
So my question is more about your circle of competence, as you call it. Do you recruit people to expand your circle of competence? Number one, and if yes, do you recruit students from MIT programs here?
I think I would be put to shame if I recruited someone from MIT, because I think they probably know more than I would. So to answer your first question, I think when it comes to an investment, to ask the question is to answer it. So if you identify a business and you're asking yourself, is this business within my circle of competence? That actually might be really telling. Thank you for coming. It might be really telling that it doesn't sit within your circle of competence. Now that doesn't mean that you shouldn't allow your curiosity to drive expanding your circle of competence. So that's how I think about it. I think way too many people think about how big is my circle versus actually what's my knowledge of depth within that circle. But when it comes to expanding it, I think that investing is essentially a journey, right?
Sure.
And how we are as an investor is the sum total of all the experiences that we've had in markets. And that's why reading is so important, because I think reading and interacting with other people is the main way to broaden it. But how do you know what to read? What should you read? And that's where I think curiosity should drive your investment process. That's how I drive mine. So I gave you some ideas about how to source potential investment ideas. I said start with the A's. You decide you want to invest in the Philippines because it's really cheap,
Right.
screening-wise. So you're like, I'm going to start with A, I'm going to go through Z, I'm going to identify great businesses. It's definitely one way of doing it. But there you've fundamentally chosen a market because you think it screens cheap.
Right.
Whereas for me, my curiosity attracts me to situations where I can be a contrarian. Because I've always found that I am drawn to situations that other people wouldn't normally be. So an example would be China or Turkey. So Turkey, it's a basket case as a macroeconomic situation goes. You've got the president of a country, Erdogan, that basically thinks that to decrease inflation, you should decrease interest rates. The polar opposite of what we would all think from just knowing basic economics. The Turkish lira from when we first invested in there has gone from 1 to 3 to 1 to 30. It's literally gone from to 10% of the value it was when we originally invested. So all the foreign direct investment within Turkey is basically left. Investors are fleeing the country. So then why would I want to invest there? Because that's where the opportunity will be. As a contrarian investor, that's what attracts me to that sort of opportunity, because I know that if everybody else is selling, they're definitely going to be selling some things that are really valuable. So an example of a business we didn't invest in it, but one that I found was an orange juice manufacturer in Turkey. So if you think about this, incredible business, very simple business. This business grows orange trees. They pick the oranges, press them, put them into orange juice concentrate, and they only sell them into Europe. They're actually the biggest orange juice exporter into Europe. They only get paid in euros, but all of their costs are in Turkish lira. And they obviously planted the trees back in the past. They also, because it's an incredibly well-run business, they use very little labor, so they don't have to they use very little machinery, and they use a lot of cheap labor. So their costs actually over time have been going down because they don't keep it they don't increase wages relative to inflation. And at the same time, even if they sell exactly the same amount of orange juice next year and don't decrease their prices, if the lira goes down by 50%, the business becomes 50% more profitable. So that's an example where you can identify an exceptional business in an environment where everyone will be like, no, this is a basket case. Stay as far away from that as possible. And that's where you have a differentiated view. You identify an exceptional business. And of course, there's going to be a lot of volatility in the share price. But the discount to intrinsic value, the discount to intrinsic value that a business like that might be trading at might be so substantial that it makes up for the risk.
So you're not actually hiring people to expand your circle of competence. You're saying that you don't need others. You just need your own curiosity.
So that's my personal perspective. And that's actually one of the reasons why I come and do talks here at various universities, because I want to learn from people like you. I want to hear what you've got on your mind and hear your ideas. I also really believe that to teach is the best way to learn. And actually, by putting these presentations together, it helps me with my own investment process and my own investment thesis. And when we have these back and forth discussions, or where you ask questions and I explain to you how we think about things, it also makes me question my own methodology. And I think that's how you grow your circle of competence, which is exactly this. It's back and forth, it's reading, it's following your curiosity. And I think it'll always take you to the right place over the long term, because you're only going to persevere at something that you find interesting. I think that's general career advice. No one ever said it to me back in the day, but I look at some of my peers that just went and took the job that paid the most money. They were like, I'm going to be a lawyer because it pays really well, even though they had no interest really in law. And I would say that that's a life half lived. You should follow your curiosity. You should follow your passions to a degree, but your curiosity is really important. And I think it'll lead you potentially in the right direction.
Thank you. Appreciate it.
Very welcome.
Time for one more.
Of course.
So I am curious how you translate your macro knowledge into the micro decisions that you make. So I also have macro backgrounds with the IMF before, and I want to use that knowledge in these micro decisions, but I don't exactly understand how to. So I'm curious, how did you find that process? And you're very successful with that. The examples that you mentioned with Turkey and China. If you could talk about that.
So I think it's going to be very much down to you as an individual. So our firm, we're bottoms-up stock pickers fundamentally. So you could argue, we totally ignore the macro and just look at the business. As the example with the orange juice manufacturer in Turkey. We just care about the business. But then, if you take a step back, you go, but how did Ardal come up with that investment idea? Well, it was from a macro situation. Because I told you the lira is depreciating, inflation is running rampant, and they've got someone that really doesn't understand basic economics in charge of the country. So that's macro, and all the foreign direct investment is leaving. So I would say that you can identify markets and sectors with macroeconomic knowledge. But then the second step to that is the bottoms-up approach of individual stock selection. That's how we operate. But I'd say that having a knowledge of the macroeconomic environment is incredibly important. Because if you think about any business that you invest in, even if you say, I'm going to only invest in US small cap stocks, right? You'd argue that's massively narrowed down your circle of your investable universe from 45,000 to probably 2,000, roughly, businesses. But within that, each of those businesses is going to operate in quite a lot of different geographies. I'm actually willing to bet almost all of them operate more than just outside the US. So on that basis, you do need to have a bit of knowledge about the world and world affairs. Because if half of the company's revenue is coming from Turkey, but it's a US-based business, you need to know that. Because that's going to have an implication on how you value the business. What's the discount to intrinsic value? The macroeconomic circumstances of Turkey or China is one of the reasons why we need an even bigger discount to what we perceive intrinsic value to be before we'll buy. Because the discount needs to incorporate the risk. And for example, in China, you have risks that are not necessarily the same risk that we might have in the West. So one of the risks that we would point out in China would be, with the various VIE structures, we can go into the technicalities of it, but like some of these businesses have very strange legal structures, whereby you don't actually own any shares in the underlying business. You own a call on some of the cash flows if the business's management decides to pay. That's essentially what you own if you own Alibaba. You don't actually own any of the assets of Alibaba in China or anywhere else in the world. You own a claim on the stream of cash flows should the management continue to pay them to that offshore structure that then passes them out to you as a dividend. Now, there's a risk with that structure that the Chinese government says, we're not allowing your companies to operate that structure anymore. They could also say we don't want any foreign investors anymore. Those risks need to be incorporated into your discount to intrinsic value. Those risks are real risks, but they're macro risks. But fundamentally, they do feed into the evaluation of the business. Thank you. Okay. Oh, okay. That's totally fine.
What was the hardest part of starting your own hedge fund that you didn't expect, rewinding to when you were in uni?
I think when you're in uni, it's really important to set like long-term goals. So my goal, they're saying, I want to start my own fund with 10 million. I don't know what the fund is, but I know I want to run my own business and I want to run my own fund. Which is, in hindsight, a ridiculously ambitious goal because there's absolutely no guarantee that A, within that time frame, or B, with that amount of money, or C, that you'd be any good at running a fund. But I think part of that is having an entrepreneurial mindset, which is that entrepreneurs in general are just driven towards certain goals, and that's what you then work towards. So I had a bigger long-term goal, and that's what I worked towards. And so therefore I wouldn't discourage anyone here. It doesn't matter what your goal is, especially if it's really ambitious. I think that's even more respectable, because what's the worst thing that happens is you end up somewhere near it, and then hopefully you'll have achieved something great. And then, what was the hardest thing for me? Well, the hardest thing for me was we were meant to start our fund on January the 1st of 2022. So if any of you remember, January 1st of 2022 was essentially the peak of the post-COVID bull market. Thankfully for me, and this is where luck comes in, our application to be regulated in the UK by the Financial Conduct Authority was delayed for a series of months. So we actually didn't start investing until November of 2022, at which point the market was down 25%. So as value investors, that was fantastic because all of a sudden we could buy amazing businesses at much better discounts to intrinsic value. So that, as you're listening to that, you think, so how is that a problem? Well, the problem was that the anchor investor for our fund was put off by the volatility of the market. So they had originally said, we're going to come in and we'll be the anchor investor in your fund. And that was the genesis of starting my own fund. My money and my management team's money, establishing the business, which is a very expensive, long drawn out process, followed by then having an anchor investor come in as our first investor. But obviously interest rates went from 0% to 6% over the course of 9 months. Everybody's financial situation changed. So actually the hardest thing for me on launching a fund was launching it with no investors. That was the biggest risk. But I guess for me as an entrepreneur, I was like, well, we've just spent the last 18 months setting this up. We've invested hundreds of thousands of dollars in getting the systems, policies, procedures, processes in place, having the right team, the right office. We've got no choice, actually. We have to go for it. And actually, how could I ever come here and talk to you today about being a contrarian investor if when the market's down 25%, I wasn't willing to put all of my own money in at that point? So that, I would say, was the hardest.